Yo, what's going on, YouTube? So I'm going to be redoing the stream from earlier. I'm going to be going through my report again for today. Um, so yeah, let's get this show on the road. So today is January the 23rd, 2026, and here's something that you might need to hear, or might want to hear. Uh, and then let me move my keyboard closer. So right now, uh, I'm going to be reading from a report that's generated using one of my AI assistants, and I created it myself. Quite extensive, and I think that a lot of people might enjoy it. So, um, right now, silver has officially entered into triple-digit territory for the first time ever in history. Um, Today, we have experienced silver breaking over $100 per ounce and closing around, well, it's still going up. It's right now it's at $102.52. And that's quite the achievement. It's definitely today's a historical day, I would say. And gold is also very close to hitting $5,000. But silver's catching up, and silver seems to be catching up very quickly. Um, so to put this into perspective, um, one of gold's strongest weekly moves is this week, since 2008, and that's that says a lot right there. And but here's what my report says: what's actually going on. So it says here that this isn't just a price spike. It says here it's a confidence leak. That capital isn't just chasing yield anymore. It's a fleeing uncertainty in currencies, policy, and bonds. This move that we're seeing from a silver standpoint, this is a moment where it stops being the cheap cousin of gold and starts acting more like a core monetary metal again. So for crypto folks, this is a canary. When metals go parabolic against the dollar, it's the same underlying stress that eventually fuels the next big move in the leg of Bitcoin or Solana, for instance. This tells us one thing very clearly, that the market is voting hard stuff over promises. So let's move on to the next thing that y'all might need to know about today. Here's where the silver gets even more interesting. Under the surface of $100 breakout, you've got real structural tightness going on. and analysts were still publishing $75 average price forecast for 2026 just a few days ago, even. And they're already pushing up their estimates because of ongoing supply deficits and industrial demand, especially from solar, EVs, which are electronic vehicles, and also electronics, just in general. And the market just blew straight past the market expectations. So now you've got mainstream pieces debating whether the silver can even keep up, or whether it's going to keep outpacing gold this year, pointing to the fact that silver has already massively outperformed already in 2025 and still sits historically cheaper versus gold. From a scarcity angle, this is what happens when you use your monetary metal as a input to the energy transition, and then try to reprice it in a world where there's rising debt and a softening trust in society and its monetary system. And from a crypto angle, this is the same theme. The scarce digital supply, scarce metal supply, and abundant fiat. It's all the same. And if you're wondering why y'all should care, it's because once a market reprices because of structural deficits, it usually just doesn't go back to normal. So let's keep going from here and let's talk about how the dollar and gold together talk about the dollar and gold together because that relationship is also flashing very red. And gold is putting in its best week since the financial crisis era, while the dollar index has stumbled for quite some time. And a lot of that is coming from investors looking for a hedge against certain policies, volatility, and reserve currency risk. So it's not just inflation that we're dealing with. And here's the deal: when the world watches the United States juggle high interest debt, tariff threats, and also geopolitical gambits, they don't argue on Twitter anymore. They quietly diversify out of the dollar asset into buying certain precious metals. Central banks have been doing this for many years, ramping up gold buying and gradually diluting the dollar's monopoly as the only safety asset. And from a silver standpoint, gold is basically dragging us into a new regime where both are treated as anti policy assets and not just inflation hedges anymore. So for crypto, this is the bridge. That's the very same people that are nervous about the dollar credibility are the ones eventually asking, what's my non-sovereign hedge now? Because where can we go when it's not precious metals anymore? And this tells us the story that the dollar collapse, it's a dollar, more like a dollar downgrade. And if we move on into crypto with this logic from here on, because that's where a lot of the tension really is nowadays, is the global markets. Here's the wild one. So where while gold and silver are indeed ripping, Bitcoin is getting a direct hit and is still holding a very large valuation. See, the spot Bitcoin today is trading below 90,000s, roughly around 90,000 to $91,000, after already tagging the high 80s intraday for many days, for many weeks. And as metals went vertical, headlines are calling it a crash. But here's what's actually happening. You're starting to see a rotation inside the anti-fiat bucket. Some of the speculative capital that front ran Bitcoin as an inflation hedge is now chasing the immediate momentum in the precious metals markets, which have lagged for many years, in fact. And at the same time, deeper research notes are saying that the 2026 outlook for Bitcoin is more about consolidation and macro liquidity rather than explosive upside pressure, and warning us that upside may be capped in the short term, even though long term fundamentals are still intact for the global markets or Bitcoin. And then you also have got AI model roundups projecting a 85,000 to $180,000 range, which is actually a very large range. So there's not a, there's really no estimation on where this could go. And for BTC by 2026, we really don't know, which is kind of a scary thing because basically the market's way of saying we know it's big, we just don't know how crazy it's going to get. And from a silver angle, it's almost poetic that the old monetary hedge is finally catching up as the new one takes a breather. And from a Solana angle, this environmental change favors ecosystems that are actually doing things such as my website. High throughput, real users, and real fees are not just a store of value narratives anymore, They're actually real businesses. And so let's stay in crypto just for a few more minutes here, but zoom out specifically into Solana. So here's something that most people aren't fully pricing in on Solana right now, and that's that on chain, Solana has quietly become one of, if not the most active major chains by daily active addresses. Using rolling weekly averages, data from earlier this month shows that Solana at the top of the leaderboard for activity by 2026 so far. On top of that, we got fresh headlines just this week about Solana addresses jumping from roughly 14.7 million to nearly 19 million as a speculation in AI-themed tokens that have exploded. And new capital is experimenting with DeFi and NFTs on Solana. Price-wise, Solana is sitting at a highs of 120s today, around $129, which is modest compared to Bitcoin's highs, but impressive also considering the chain's earlier crashes and outages. And what my research is referring to is the DDoS attack that occurred to the Solana blockchain here recently, but it only resulted in about a 400 millisecond interruption, which is actually quite incredible because I know that when I play World of Warcraft, my ping can go to like over 1,000, and I'm like totally screwed. But anyways, for the Solana, here's the takeaway. Activity plus the fees plus real usage are starting to matter more than just a pure narrative standpoint for most cryptocurrencies. And Solana is a really great achiever of these. So for silver and scarcity, the parallel is very simple. Just like the silver industry, reality is forcing a repricing of many different things, and Solana's actual throughput is forcing investors to re-rank the L1 blockchain stack. And that's why these numbers matter, is because we're seeing what's actually being used and what's actually being utilized. All right. Now let's build on that with Solana's bigger arc or more interesting theme. So hold on, let me grab a drink real quick. I'm very thirsty. So, um, yeah, from the bigger picture perspective for Solana, it is slowly graduating from what's called a high beta alt to a base layer infrastructure for the entire cryptocurrency ecosystem. You've got data-driven forecasts talking about Solana's potential just in 2026 alone, with price targets literally all over the place, just like Bitcoin, from sub $200 to north of $700, but all anchored towards one thing: a growing decentralized exchange volume, NFT usage, and institutional curiosity. You've got fresh fundraising news like Superstate raising more than $80 million explicitly to bring traditional capital markets, fundraising, and even IPO rails on chain, with Solana as one of the key platforms alongside Ethereum. And then you've got curated lists on top of Solana projects for 2026 that aren't just memes anymore, y'all. They're actual DeFi projects and real businesses, real infrastructure plays, real world asset experiments, and NFT ecosystems that are maturing on top of this chain. And for the crypto side, this means that Solana isn't just chasing a price target anymore. It's compounding network effects for scarcity. For the scarcity angle specifically, think of block space as the way you would think of a silver ounce, for instance, limited, useful, and increasingly demanded. While when demand meets constrained capacity, pricing power emerges. And that's just basic economics. So while Bitcoin is consolidating and metals are exploding, Solana's quietly doing the unsexy work of becoming the rails. Now let's zoom out now to the macro backdrop that all of this is sitting in. So here's the macro picture that you need in your head today, y'all. The 2026 shaping up is not necessarily a crisis, but not exactly comfortable either. Major outlooks from mainstream shops are talking about the United States growth this year in that 2.2% to 2.8% range. With recession odds pulled down to around 20% for the next 12 months. At the same time, policy think pieces or thought leaders are describing 2026 as a meh year after a bout of mild stagflation, and not necessarily a boom or bust either, but instead a stretched system with very little slack and a lot of nervous households that are starting to become more aware of their financial situation. The yield curve, which used to be deeply inverted, now has uninverted and has turned most modestly upward. And with the 10-year minus the 2-year spread sitting around plus 0.65% to plus 0.7%, right in line with the data from mid-January. Historically, that is a uninversion, and it is the awkward middle zone, but it doesn't mean everything is fine either. Um, so what this means is the signal has officially changed, y'all, and the markets are repricing what comes next. So for metals, that kind of environment is perfect. Growth isn't strong enough to crush safe haven demand, and also policy isn't anchored enough to rebuild the deep trust in the bonds markets. So for crypto, a shallow, uncertain expansion with a high elevated debt tends to push more people into a non-sovereign or high beta assets whenever liquidity loosens. This is the background hum behind every chart you're looking at right now. To put this into better perspective, there's two traditional financial systems. There's the what's called the let's see here. It's what's called the Western Keynesian style of economics versus the Austrian framework. And just to put this into perspective, the Western Keynesian style thinking treats markets as short-term systems driven by sentiment, momentum, and reactions. And that mindset leads to it could go up, it could go down approach, which is the trader mentality. And it builds on predictions and constant adjustments. And in contrast, the Austrian hard money philosophy focuses on long-term value, ownership of real assets, and lowering the time preference of your transactions. And it removes the need to predict anything by structuring entries, exits, and position sizes so that risk steadily moves towards zero. See, the approach that my website follows is taking hold of the Austrian framework. It is a long-term system built around stability, not speculation. It is a 100-year strategy based on principles that have been in use for centuries. And the goal isn't to react to volatility, but to build something that functions regardless of it. Now, traders respond to the market movement, and investors create a structure that outlive those market movements. And that is the basic distinction between the two philosophical monetary systems. And here's where the stress really shows up in a way that regular people feel every month, which is consumer credit. See, fresh stats on the US credit card debt is going into 2026, showing records or near record balances and interest rates that are still very brutal. And even though they have ticked down slightly from their peaks, average APRs on cards accruing interests are still above 22%, and overall credit card APRs are still just under 21%. And the New York Fed's work on the delinquency shows that while the big surge in late payments has cooled compared to the 2022 and 2023 spikes, the delinquency rates remain elevated versus the pre-pandemic era and haven't really improved in a way that feels like a very rock solid relief, you know? And here's what that actually means. Households are paying more to just maintain what they have. And from a silver and crypto angle, this is important, very important, because when people feel squeezed, they're more receptive to narratives about escape. And whether that escape is in the form of a hard asset or a yield strategy or speculative punts, from a philosophical standpoint, it's a reminder that the macro story is ultimately about the human cash flows between every corporation and person, and it's not just some fancy chart. So let's move from the household standpoint to something much bigger, which is the wall of commercial real estate debt. So here's where the system is quietly taking a stress test as well. So commercial real estate is refinancing, and reports are coming into the 2026, and all are basically saying the same thing, that we are in a make or break phase for a huge chunk of office, retail, and mixed use loans. For over the next few years, more than a trillion, or I'm sorry, yes, more than $1 trillion in CRE debt is set to mature, and most of it was written during an era where zero rates and lofty valuations were very typical. And now lenders are tightening very hard. The new notes describe 2026 as an underwriting as ruthless. Refinancing is back, but only for the high quality borrowers and assets that can actually stand on their own at today's rates. For instance, something like what silver's done within the past year. So for the system, this is a slow motion X-ray, which shows weak properties, and over levered owners are going to feel this pain. But the debt markets themselves might muddle through if spreads stay contained. So from a silver and crypto standpoint, the CRE is like a giant levered bet on an old world of cheap money and centralized offices, which is actually kind of a great quote when you really think about it. And as the world gets repriced, the relative appeal of decentralized, low overhead systems from digital assets to permissionless rails looks less crazy and more inevitable than ever before. And so that's one structural crack that's starting to show. Now let's zoom straight into the debt clock mindset, which honestly I'm not a fan of because it's a lot of numbers, and to many people it just doesn't make any sense. But we're going to do it anyway. So because this is where the numbers hit you in the gut, here's the crazy part. Depending on what clock you look at, the U.S. national debt is somewhere between the high 20 trillion and mid 30 trillion range, and the total government debt, including state and local, is projected for the low 40 trillions. One widely cited, frequently updated tracker has the national debt just over 29.4 trillion as of January 19th, 2026, with the debt to GDP at roughly 140%, debt per citizen around 89,000, which is actually much higher. I just looked at it today, and the annual interest payments of north of 220 billion, more than 7,000 interest every second, and another set of projections using a broader definition and budget assumptions sees federal debt alone closer to 39 trillion by the end of the fiscal 2026 year, and total government debt at about $42.8 trillion. So here's what it's actually telling us. And even the definitions of debt can't keep up anymore. So for silver, this is pure fuel. If you're denominating a fixed number of ounces against a rapidly expanding claim on a future income, uh, that's what happens. And for instance, For crypto, it's an advertisement. And here's what it says. It says that here's the part of the system that can't be printed. And if you're wondering why you should care, it's very simple. It's because these numbers redefine what risk-free actually means. So let's go deeper into the interest side of that. So the next part is really interesting when you really think about it. The interest on the debt is becoming its own shadow budget. So using that same commodity style debt tracker, damn, I just need a moment. Ooh, that's a lot of talking. All right. So, where was I? So, using that same commodity style debt tracker, annual interest payments are already well within north of 220 billion a year at the current setting. And that's before you roll forward higher rates and also bigger principals for a few more years. At the same time, analysts of the debt clock style platforms show that as rates reset and the principal grows, interest can creep up to becoming one of the largest single items in the national spending without a single vote being cast. And here's why that matters. Interest is a non discretionary drain. You can argue about programs, but you really can't argue with coupon payments without triggering a full blown crisis. And from a silver angle, this is exactly the kind of long duration, slow motion debasement that hard assets thrive on. You don't need hyperinflation. You just need more debt than growth. And from a crypto angle, this is the macro case for non state monetary assets. They are not competing with your government's budget anymore. They exist literally outside of it in the blockchain cryptocurrency space in the global markets. And this is one of those signals that you don't want to ignore because let's touch one more piece of the debt story when what's not necessarily on the clock. But before I say that, I do want to say that the reason why you don't want to ignore these signals is because even in the Western Keynesian style economic theory, you always follow a trend. And even now, when the trend is like bridging over to the Austrian style of economics, um, it's still following a sort of a trend. And I don't know exactly where it's going to go from here, but some of the breakdowns of the US debts accounting point out that the headline figure leaves out whole categories contingent liabilities. And so those are things including from mortgage related entities to long term promises like pensions and healthcare, and with one analyst estimating that roughly $5 trillion of obligations were effectively kept off the books through accounting choices. When you layer unfunded liabilities and guaranteed entities on top of all of that official debt, and then the real leverage in the system becomes much higher than the headline suggests. And then this isn't necessarily a conspiracy, it's just the actual structure of the debt clock. And from a silver standpoint, this isn't why hard assets don't need anyone's permission to reprice. They're not waiting for some legislative confession either. From a crypto and Solana standpoint, this is why increasingly comfortable people are becoming more increasingly comfortable holding assets in systems where the rules are very transparent and more on chain. And even if the prices are indeed volatile, if you're wondering why you should care, it's because the gap between what's promised and what's funded is ultimately paid for with your purchasing power. And let's connect this back to the markets before we wrap this up, because right now the stock market itself is sending a very mixed message. Veteran bond managers are out there saying that record equity rally is wobbling and might need a cane. I'm very sorry to say this, but I'm getting older. My dad's getting older. This whole financial Western Keynesian style of economics is getting older, and this show can only go on for so long. And that's only pointing out to stretched valuations and AI driven hype and fiscal interventions that simply prop up the weak players, all while warning that the future returns could be suppressed from these levels. And at the same time, you've got very optimistic voices in Davos talking about the US growth potential printing north of 5% in the first quarter of rates coming that are going to come down. A huge spread between cautious markets, veterans, and policy adjacent optimists. This is where things get more interesting, is because the macro data is saying moderate growth, less recession risk, but the balance sheets are saying higher debts, higher rates, and thinner margins for error. For silver, this environment is actually perfect for repricing because the assets that you go to when you think growth continues, but debt overhangs everything else. And for crypto and Solana, it's the zone where high beta assets get hit first on the liquidity squeezes, but also where they rip the hardest when policy loosens. And it's a trader's environment as well, not necessarily a retiree's environment. Because let's touch on the central bank's credibility for a minute, because that's another quiet driver that's pushing people more and more into hard assets. Finally, we're going to talk about that. So, the narrative under all of this is central banks misjudged inflation, and everyone knows it now. And the Bank of England just openly admitted that it systematically underestimated wage growth and inflation after 2022. And with the forecasts off by roughly 3 to 5 percentage points and unemployment projections too pessimistic, the policymakers are now warning that strong wage growth could limit how quickly they cut rates in 2026. And even as the inflation stays above that target, it's not just the UK. Globally, central banks are juggling the same trade off: high debt, sticky inflation, and political pressure do actually do something. From a philosophical angle, this is an erosion of authority. If the people who set the price of money keep missing the plot, the markets and individuals are going to look for a parallel system where the rules are much more simpler. Ounces, hashes, blocks. That's where silver, Bitcoin, and Solana are all lining up, and each in their own very way. That's why I created my website. The link is in my description. So here's the bigger story of the January 2023, or I'm sorry, 2026 to 23rd. If I had to put it into one thought, is that metals are indeed screaming that trust in the fiat system is eroding at the margins, and the Bitcoin is reminding you that even the king of crypto can be volatilely repriced in the short term while the long-term thesis still holds. Solana is quietly evolving into real infrastructure that, under all that volatility, is still holding steady. The debt clocks are telling you that the promises grew faster than the productivity was going to be projected, and the interest meter is ticking whether anyone's paying attention, whether or not anyone is paying attention. And above all of this, the system is shifting from a world of blind trust into institutions to a world where people are increasingly want more receipts, and those receipts come in the form of ounces. Those receipts come in the form of satoshis, and those receipts come in the form of on-chain proof of work and proof of transactions. And if you're listening to this wondering what to do with all of it, remember that I'm not your financial advisor, and I'm not here to tell you what to do with your money or what to buy. But I am here to help you see the landscape clearly and what's going on. And today's landscape is very simple, that the old system is still running, but the cracks are very visible. And silver, crypto, and decentralized rails are no longer just a fringe, and that they are becoming a parallel track to daily society. And that's why I watch these signals every day and not why they should matter to you. So please hit that subscribe button. It would mean a lot to me if you subscribe. Hit that like button. It would really mean a lot to me if you were to like this video and you got some value from it. I'm gonna stop the stream here for today and take care, y'all.